Hello and welcome. Today I'm joined by Mike Kerley, who's a fund manager on Henderson Far East Income. Mike, thank you very much for joining me today. Now, 2018 was an eventful year for investors, particularly with the trade war that escalated throughout the year, and it was a very difficult year for Asian equity investors. So how did the trust perform during the period, and what are your thoughts and feelings as we go through 2019?
Yeah, I mean, you're right. 2018 was a tough year. There was quite a few things going on. You mentioned trade was one, but also perception of interest rates rising and rise further from here as well. You have the strength of the US dollar, which didn't help risk assets in Asia in general. So yeah, it was a tough year, lots of uncertainty. So we had double-digit declines, which is pretty much as bad as we've seen since the GFC. From the trust perspective, we did better than the market, but we kind of expect that. We're an income fund, we're defensive, but we still posted high single-digit declines. So we're not exactly running around with our hands in the air at this point, celebrating our success. It's always difficult to report on a down year, even if it wasn't as bad as the market in general. And as for next year, or this year now, 2019, I think we get more of the same, certainly in the first quarter, maybe second quarter. We've got the trade war extends, or the truce on the trade war extends until the end of March. Will we get a deal? Will we not get a deal? I mean, who knows? It's down to individuals. But we still have some problems, I think, with growth, both in China and in the US and the rest of the world in general. But valuations in Asia are cheap, so there's opportunities amidst the turmoil.
Now, there's been some negative press coverage in recent months regarding Chinese debt, with some commentators and analysts forecasting a Chinese debt crisis. Now, given the portfolio's 25% exposure to Chinese equities, I'd like to know what your thoughts are on this narrative.
Yeah, I mean, the debt is commented on regularly. The absolute level at about 280% of GDP is a big number, similar to the US and UK. It's the speed at which we got there, I think, is the biggest worry. So at the GFC, it was 150% of GDP. So we've gone from 150 to 280 in 10 years. So it's that speed of increase in debt which is the worry. I think more encouragingly, in the last 2 to 3 years, that level has stabilized. Xi Jinping has been focusing on deleveraging in the corporate sector, and that has benefited, I think, and come to pass. It hasn't done much for Chinese growth, I have to say, which is why people are worrying about the slowdown. You've also got to remember with the debt side that actually there's a lot of savings on the other side of that, unlike the UK and the US, where there's not very many savings here to offset the debt levels. So when you take the debt on a net basis rather than gross, it doesn't look nearly so worrying.
Now, looking at the portfolio, what can you tell us about your activity during the past quarter? Were there any new names, or was there any change to the sector or geographical breakdowns?
We haven't changed too much, to be honest. At the sector level, I think some of the biggest changes have probably been on the financials. We had a decent exposure to banks across the region. We now have less exposure. The feeling is that the yield curves are flattening across the world, especially in the US, but we're seeing that in Asia as well. And as a result, the banks won't get that earnings boost, if you like, from net interest margins rising. And as growth slows, there's less opportunity to lend, etc. So we've been reducing our exposure to banks. We maintain a healthy weight, as you say, 25% in China. And we're seeing some opportunities there in some of the growth stocks, which were too expensive for us, but now after the sell-off are a little bit cheaper. So we're buying companies that are exposed to that consumption trend. Whether it's in China or elsewhere, for example, we're buying Treasury Wine in Australia, which sells wine into Asia and obviously around the world. We're also buying Macau gaming stocks. Again, these have been sold off quite a lot. They're a proxy of Chinese consumption, which we think is not as bad as the market suggests.
Now, one more question for you, Mike. You mentioned a flattening of the yield curve there, and we've seen a lot of talk about a slowdown in the US throughout 2019, heading into 2020. Now, China already experienced a slowdown in 2018. So what I'd like to know from you is, how do you see the relationship developing economically between China, Asia generally, and the West?
Well, historically, the yield curve has been a good indicator of growth expectations. And usually when it flattens or inverts, that suggests we're coming close to a recession. I think 8 out of 10 times that's happened, we've ended up in recession. Now, why is it different in the East from the West? Well, the difference is that China has a lot of bullets to fire. We don't have the same kind of fiscal pressures or balance sheet expansion from the central banks in the US as we've had in China. So in theory, we could go through that route again in order to revive growth domestically. So I think the big difference here is that Asia can do something about it, and the rest of the world will struggle to do it because they already did it post GFC. You can argue whether that was a success or not, but could they do it again? More difficult. So that's where we're differing this time, I think. And Asia's now big enough to have a cycle within its own right, rather than rely on the global cycle for growth. China absorbs 50% of all the exports from the rest of Asia, rather than it used to go off to the Europe and the US. So Asia now is a much bigger place in its own right and can sustain a cycle rather than rely on a global.
Mike Kerley, thank you very much for joining me today.